Okay, hello everyone. Thank you for joining. It's the Q2 call with Mr. G, George, as you all know. George, you can begin.
Hi everyone, you should be able to see me and hear me clearly now. Let me know if not. And yeah, thanks everyone for joining. I see we've got quite a small group today, smaller than usual, which is not totally surprising during a bear market. But you know, it's kind of going to be a good chunk of the discussion here. The focus of the call is really about these periods that are inevitable in the markets, and how when it can, even though it can be tempting to shy away from things when things are looking a little tougher, these are actually the times where, if you're paying attention, you can really set yourself up to maximize the next bull market. So I'm going to be monitoring the chat, so feel free to ask any questions, and then I'll address them, most likely all of them, towards the end. And I would really encourage you to do this. Feel free to ask anything you'd like. And you know, as it's a fairly modestly sized call, I should be able to address everybody's questions, which would be nice. Okay. So first of all, I don't know how many of you are new or have been around for quite a while, but in any case, welcome to all of the new copiers. This can be a tricky time to join, but I appreciate your trust in me, and the same with all of you that have been around for longer. So here are just some quick tips and stats for any of you who are newer to eToro or specifically to copying me. And probably the most relevant one today would be the last one, which is to monitor your emotions. We are at the moment in the midst of quite a bearish stretch across pretty much all asset classes. And often these extremes are the most important times in terms of how you decide to interact with your investments, you know. And classically, people tend to get overly invested when things are already bullish and near the top, and to get too panicky and tend to sell things quite near the bottom. So just try and, you know, always be logical, take a step back, and make sure that you're not making emotional decisions. So as we find ourselves in quite a significant drawdown here, both speaking personally in my own portfolio on eToro, but also generally in the markets, I thought this would be the most important thing to start discussing. So it really depends on your objectives, your time horizon. You can frame drawdowns in many different ways. And the key point that I want to get across, and the way that I think about this, is that in order for you to achieve high returns, you have to go through high volatility. And, you know, this is the cliche of high risk, high return, but it's very, very true. The price of achieving high returns is high volatility. So if you're able to endure that volatility, you get the high returns. You just have to try and not get shaken out along the way. Now, of course, there can be some high volatility in strategies that are also not going to give you high returns, but that is a subset of them. I just wanted to get across the idea that it's not necessarily that things are going badly. It's just that you're in a period of volatility, which you have to endure if you really want superior returns. So just to kind of elaborate on that, I wanted to show you this example, which of course is quite dramatic, but just to get the concept across. So if we think of Bitcoin and you look over the last 5 years or so, the return has been, if you're just held the whole time, about 1,000%. In order to achieve this return, you would have had to have sat through drawdowns, 4 significant drawdowns. You can see 84%, 70, 54, and 60. The S&P, if you had just held for the same period, you would have had a much smaller return, 70%, but also fewer drawdowns and much smaller in size. The point is that this is from just holding. So this is why conviction is very important and time horizon is very important, because it's right at the bottom of these drawdowns, whether it be Bitcoin, the indices, or any other market. This is the point where you're most likely to give in because things just look like they're going to go to zero. And that's why you need to have a real strong conviction and understanding of in what you're investing. Very few people have held on to Bitcoin when it was down 85%, but those who did were the ones who got rewarded the most handsomely. So that kind of summarizes my approach to some of our holdings, which we'll get into in more detail in further slides, specifically crypto, Tesla, and some other positions. You just really, really need to understand the business or the asset and believe that in the future it's going to provide significant returns. And ultimately, you don't care about the path in order to get there. And I can see how this also applies to me as an asset class, if you will. So for you copiers who are investing in me, I realize that the deeper the drawdown becomes, the more tempting it might be to think, this is not going well, I'm going to jump ship, which is understandable. But that's why I want to be very clear with my thinking process, my strategy, so that if you are in line with that and you have high conviction in me, you will be able to hold on for the longer term as well. So that's kind of my goal, right? I focus on a longer term view, and I really try and achieve very high returns, which, you know, I have a decent track record for you to kind of verify that. There have been some drawdowns, but that the returns have always been very, very high. And of course, at the same time, I'm not just blindly accepting huge drawdowns. I am actively trying to dampen them as much as possible. And this kind of brings me to the last point here, which is that we're down approximately 30% for the year, which is a very similar drawdown to the NASDAQ. However, we have much higher beta positions, meaning that if you have a position that has a high beta, you would expect it to have a higher performance than the NASDAQ when the NASDAQ goes up, and a worse performance than the NASDAQ when the NASDAQ goes down. So like an amplified correlation, if you will. So what I'm trying to get at is that by holding those positions, we should actually be in a deeper hole than the NASDAQ. So we have done okay in terms of dampening the drawdown. And when things turn around, we should be in a position to have a much better return than the NASDAQ. So let's just take a look at markets, and I've got a couple of slides here highlighting the bearish points and the bullish points. And we're actually at a very interesting inflection point with some macro circumstances that I'd say are pretty unprecedented when you put them all together. So from a bearish point of view, you can see this chart highlights the Fed's hiking cycles. So these are these highlighted gray areas that you see here. And you can note that they're very highly correlated with periods of crash, recession, basically strong negative returns, right? And this kind of shows you the classic understanding of don't fight the Fed, everything is driven by liquidity. And to an extent, that is true. When liquidity is being taken away from the system, it's very hard for the markets to not have quite a rough time. So this kind of sets up the scene for some pain, but it's debatable if there's a lot more to come or not. this can give you a further clue. So here we're looking at the S&P's price to earning ratios, forward price to earning ratios. And you can see right now we're around 16. And of course, this is not perfect, but just a kind of ballpark reference. You can see that in previous crashes, the number has been closer to 10. So even as low as 8.5 in very dramatic crashes, but in serious corrections, 10, 13, 12, 14. So we still haven't seen that much of a fall. And this is in part because we've seen such an epic rally since the COVID lows that when things are so extended, there's a lot more unwinding to do. Yeah. Then when we look at the bullish side, a lot of it comes down to sentiment, I think, really for the bullish thesis, because a lot of the fundamentals, I would say, are pushing more towards the bearish side. But I always find these kind of analyses very, very interesting. So this is showing you the percentage of bearish financial advisors. And you can see how they always peaked, basically coinciding with the bottom of a market crash or significant drawdown, right? So here you can see the 09 bottom, and there was 55% or so of advisors that were bearish. 2020 COVID crash, 40%. And usually it returns to a level which is around 20, quite low. And we're sort of approaching this threshold level. And this would indicate that we're probably, if we haven't already seen the bottom, it's probably not that far away, because we're starting to get to a bearish extreme. And when you have these sentiment extremes, that's usually a top or a bottom, depending on the direction. And elaborating on this, I always find this quite amazing. If you look at the covers of Barron's, you can see that they are an exceptional sentiment counter indicator. So here at the top, before we saw the COVID crash, we had some very bullish cover. Then right near the bottom, a playbook for crisis. Back near the top, there's a bull with big money pole. And just a week ago or two, we had this "Don't Get Mauled" bear publication. So usually, as I said, this has been a very good indicator, even going way further back in the years. And another one from Bloomberg, the great tech rout, with all the tech stocks getting crushed. And when you think about it, it makes sense that a lot of these companies have had very, very significant drawdowns, especially tech. I think because it saw such a rally during COVID, right? All of the work from home names, they have much further down to come. But ultimately, when you look at businesses like Amazon or like Meta, Facebook, they're incredibly solid, profitable businesses. And, there's definitely a point at which they're going to be a very good buy if you have a medium to long time horizon in mind. It's a tricky balance. You don't want to be catching a falling knife, because they definitely can fall further. But all in all, I'd say we're probably close to a bottom, would be my take on the situation. And then we also have some bullish signals starting to show. So this one, for example, like the upside volume being more than 80% for 3 consecutive sessions. Even just looking at the charts, like it looks quite constructive to me in the shorter term, although bear market rallies can be very, very deceiving. There's quite a few things that are starting to point to the fact that we might have seen the bottom, or that we're at least close. then this is really the most important slide out of all of the ones that we've just been through. So a lot of people get enamored with the indices, how far down are the indices, bearish, bullish, but ultimately there's always opportunities across the market, and we'll take a look at some charts in a bit. There are always opportunities. Like if you look at these that I've highlighted here, which are ON, this is a semiconductor company, or UTHR, which is a medical company. These are very close to new highs or recently made new highs, and they have record earnings. And even though the average, the index may be down, there's always stocks that you can find or other asset classes that you can find, like recently even energy stocks, oil stocks, right, that are going to outperform. So you always need to be actively searching for that kind of thing, because ultimately, if you're invested in stocks that go up and down with the averages, you're just going to get average returns. Then on top of that, as you've seen from me over the last, well, since the beginning of the year, you can also use short positions, you can use hedges, you can have a high cash allocation. There's a lot of things that you can do to just try and dampen the drawdown, because while it's true that there are always opportunities in the markets, clearly if everything is bullish and there's an abundance of liquidity and everything tends to be moving up, then that's a tide that will rise all boats, and it will be easier to make a handsome return. But just because the indices are going down doesn't mean that you should just kind of resign to the fact that my portfolio is going to go down with it. I will say that I don't think I did the best job in managing this drawdown. My mistake was actually entering back in a little too early. So if you follow me more closely, you'll remember that we had some quite nicely timed sizable shorts, not far from the top actually, and also a sizable cash allocation. So that went well towards the beginning of the year, but then when we jumped back in a little bit early on what turned out to be just a bear market rally, that was quite painful. And now we've ended up being somewhere in line with the indices, but as I mentioned before, with some higher beta positions. So still, all in all, reasonably happy with the situation. But the takeaway from this slide is that we're not trying to predict whether the market is bottoming, whether it's bearish, bullish. I think that's the wrong way of thinking about it, because if you set your mind to the fact that this is a bear market and you just short everything or you're entirely in cash, it can easily turn around and then you're stuck on the wrong side of it, and your ego can easily get in the way because you don't want to be wrong. Same for the other direction, right? So it's not about trying to predict the market, because nobody can really do that. It's just about having an effective plan for every scenario. So right now, if the market's moving a certain way, and we really have evidence that we're going to have more of a recession, more of a crash, something like more akin to 08, 09, which, I don't think is likely, by the way, but it could happen, right? So you always need to account for it. I will be ready to be in cash or to go heavily short. Same with the other direction. You might have noticed, again, if you follow my portfolio more closely, that as things have been calming down and consolidating and some stocks are starting to look good, I started to add some of that long exposure to the portfolio. So you just need to have a plan for every scenario and not try to just be fixated on one side. And at the same time, also to not just be passive. Because if you just sit with your investments, you're always open to the possibility that the market can go down 70, 80%, like it's happened numerous times, right? And then your portfolio would just go down with it. So you need to be proactive without trying to predict. And okay, so just to kind of drill down a little bit into the current positioning. So our portfolio at the moment is around 53,000, and we still have a very sizable cash allocation. Currently have about 35% of the portfolio in stocks, all long. And then I have a hedge, a levered ETF short for $4,000. It's 3 times leverage, so it's approximately 12,000. So these two kind of balance each other out, leaving around 6,000 net long exposure in stocks. And I want to highlight that they have tight stops. So the position that we're at now in the market is one of a potential turnaround. So we want to be positioned with some long exposure just in case it follows through and we see like a brand new rally. But at the same time, it could just fall apart and go lower. And in that case, you want to get out with the smallest loss possible. And then I've maintained some long crypto positions for a smaller portion of the portfolio. So yeah, we're fairly hedged, and we're just kind of waiting for some clearer messages from the market. Yeah, I don't think there's anything more to add here to this slide. So as a recap here, you might have seen, you remember this slide from previous presentation, but I think it's just important to kind of reiterate. I always go into my investing with the idea that black swan events do happen. And as humans, we're pretty bad with estimating probabilities. So we tend to just discount things that seem, you know, if it's a 1% event, you would just write it off. But even if that event happens once a decade or once every 2 decades, it can be so significant, like an 80% drawdown, that it can just decimate your portfolio quite literally, right? And then that takes a huge amount of work to recover from. So, you know, you might say that I'm a little paranoid with it, but I think it's good to protect, to be prepared for even these kinds of scenarios, because sooner or later it is going to happen. And if you're prepared, you will have already thought about the proper course of action. And if you're not, you can be in trouble. I also take a long short approach. So my long-term goal is just to be invested in the stocks or other assets like Bitcoin that I think are going to perform the best in the future and that define the future. You know that I've been a huge Bitcoin and Tesla bull, Ethereum, a few stocks like this and cryptos for a long time. And I continue to think that those kinds of things, figuring out those things that are going to define our future and provide the most value to the world is the way to go. There's nothing better to invest in. So I try to like quite aggressively find and invest in those. At the same time, if the market is not cooperating, I'm quite dynamic with my cash allocation and also happy to short the market or individual stocks, whether that be like an outright short. Sometimes you can just profit from stocks that are overvalued, or whether it be a hedge. So I'll only be looking to be fully invested or even leveraged when the times are right. So right now, the trend is down, but at some point it's going to turn. And when it turns, everyone is going to be bearish, and there will be some amazing opportunities on the table. And that is the time where we will be going, slowly becoming fully invested or even levered. And we will be in a position to make absolutely the best return in the next leg up in the market. And finally, this, I don't know how best to describe it, but if you look back at my performance, I'm a little obsessed with finding opportunities that are just dramatically asymmetric. So I'm happy to take a lot of small losses when I think that the expected value in that position, if taken multiple times, is going to be positive, right? So if you imagine you take a stock that you think it has a 50% chance of going down 10%, but a 50% chance of going up 200%, then you're always going to happily take that investment, right? Even if you get burnt 2 or 3 times for that small amount, eventually, if you were correct in your estimations, the gain from the wins is going to hugely overshadow all the small losses. And if you look at my chart, you'll see that this is kind of the way it tends to go. So things can be, excuse me, things can be trending down for a while, or flat, or slightly up, and then you will just see these huge bursts, whether that be from catching a crypto at the right time and with a significant size, or a specific stock, or being heavily short the markets like I was in March 2020. And so, yeah, this tends to require patience. But as you can see from my track record, it has outperformed over time. And I know it can be frustrating when there's long stretches where there aren't many of these bursts, or it doesn't seem like there's many opportunities, but unfortunately that's just the name of the game. And the psychology of humans is such that the worse things get, the less crowded the opportunities are going to be. And eventually there are always going to be new opportunities. So I think this is my last slide. Yes, it is. So I think we have about 15 minutes, if I'm not mistaken, for questions. So I'm just going to pull up the chat and see what we have here. So the first question is concerning commodities, that I don't seem to be trading them that much anymore, like actively as I used to. Isn't this where there is short-term trading opportunities to be had? So it's a fair question, and let me just get up some charts. So you should be able to see this chart of cotton right now. And I just thought of cotton because I believe I had a big position maybe somewhere around here. And I closed it somewhere around here. The point is that sometimes, even though an asset class might be trending up, I don't really see commodities as a good investment because they're not actually producing any value, right? When you think of a company, a stock that's producing a product, it's making a profit, it can grow. The value of commodities is very, very cyclical, and they tend to have these very like boom and bust cycles. But ultimately, it's sure there's some supply and demand, but a lot of it is speculation and isn't really driven by fundamentals. You know, if you pick a good stock, or almost if you pick, let's say you've invested in the S&P over decades, you will have made a huge return, right? Even investing in random stocks. If you'd invested in a basket of commodities over the same time, you probably wouldn't have done very well. You can see this specifically with gold. If you look at gold's performance over a very long time frame, it just is really pathetic compared to stocks. So even though I did have quite a few commodity trades in the last 6 months or so, they were more chart based, technical, like based on technical analysis, just some kind of momentum move, and they'll always be quite short lived. And it just so happens, I mean, I do monitor them, but it just so happens that I haven't really seen any major opportunity. And these are always defined, as I was explaining before, by the asymmetry, by the risk reward. So, you know, you could invest in something like cotton that has been trending up, but I don't want to be exposed to these levels of these swings. You know, I want to find somewhere like this where I can quite clearly define my risk to, let's say, this kind of level, like a 5% risk, right? So I'll probably have my stop loss somewhere down here, and then I'll be happy even just with this short move, which was a 15% move. I can't remember exactly where I exited, but you know, that's a nice 3-to-1 risk reward. So that's the kind of thing that I'm looking out for, and just haven't really seen much of. It might be caused by what's happening in the macro environment, you know, natural gas, oil, like wheat, all these things have moved like crazy, mostly because of the whole Russia and Ukraine situation. So there was opportunity there, and we did have a really good trade in oil actually when that happened. Maybe wheat as well, I can't remember. But then the nature of that kind of move is that it's incredibly volatile. So it also becomes very risky. And once the big move has happened, it becomes very difficult to enter that position with a small and defined level of risk. I hope that answers the question. So next one is, it seems you're more passive recently, fewer trades and 40% in cash. What is the reason for this? Do you not see opportunities at the moment? So hopefully over the last few months, my high cash allocation would have made more sense to you. It's something that I've been advocating for a while. So I think even close to the top in the NASDAQ, I had just a very high cash allocation, just because things looked hugely overextended, things were starting to gap down, and it just wasn't looking good, right? And that can be perceived as, hey, why are you not investing this money? But cash is absolutely a position, right? So depending on how favorable or unfavorable the markets seem, you can go on the defensive by entering into cash, right? And as you will have seen this year, it's been very hard to find stocks that have performed, that have given a positive return. So if I had been 100% invested in stocks, our drawdown right now would be much more severe. And as the drawdown continues to increase anyway, I've become kind of exponentially more cautious, because right now we're at 30, which is kind of where I draw the line in the sand for, you know, an acceptable drawdown that that I really wouldn't want to go much further. So I'm trying to be very cautious, and I don't want to jump the gun until I really see some bullish momentum in the market. So, and also, yeah, there's just less going on, right? There's fewer, even though, as I said before, there are stocks that are performing well, they kind of tend to be few and far between. So it's just harder to find things. If you look back to 2020, you could almost pick any random stock and it did very, very well. Right now, you have to be a lot more picky. And yeah, so I'm just being cautious. And also, yeah, there's a limited amount of opportunities. And a lot of the stocks that I have invested in are still having to kind of prove themselves. So this was a stock that I mentioned earlier on, the semiconductor company. You can see down here their earnings have just continued to balloon. So it's a nice growing company. And here we are, like very close to their all-time highs. So this one in particular is looking very good, but at the same time, there's no guarantees, right? It could just turn around and head back down with everything else. Whereas once we start to see more stocks really making new all-time highs or just having like strong bullish momentum, then I think that's a better time to turn aggressive. It's better to be a little bit late than to be early. If you think about it logically, if you're invested in the NASDAQ here, you think it looks bullish and you want to make sure that you're not late. Well, you're down 30%, but as I said before, it could go down 40, 50, 80, it could. And so you could be just catching a falling knife. Whereas if you give it time to, let's say, prove here that it makes another high or that it reclaims the 200-day moving average, something like that. Sure, you might have not nailed the exact bottom, but at least you have a very high probability bet that that you're back in a bullish environment. So I would rather tread with caution. Okay, another message. Mostly just a thank you message. So yeah, thank you for your kind words and for your trust. And they also mentioned, do you already know how much in percentage is going to be the monthly deposit you told us about? I like the idea and I want to get ready to follow it. So if you see, I think it was my most recent post, I mentioned that I needed to add some funds in order to maintain the Elite Pro status that I have on eToro. And that I also thought it would be a good time to do it. You know, these times where everyone is bearish, people are selling, people are giving up on the markets, that is the time where if you persevere, you will look back on it and be very happy that you were able to find that strength. And it might take some time. So I kind of wanted to lead by example and said that I would be adding a manageable amount to the portfolio at the beginning of every month. So I don't want this to be burdensome for anyone, and you don't have to add when I do, but I think it's definitely a good time to be adding just a small percentage, just dollar cost average into these stocks, like these high quality stocks that are starting to show like very attractive prices. So I think on the 1st of June, I added, I think it was just under 2%. You should have got a notification for that. And I will probably stick to the same kind of number, like between 1, 2, 3%, something like that every month. That is the current plan. Next question is about cryptos. What is my opinion on cryptos like Ethereum and Solana for the long term? Would you consider increasing your positions on other cryptos? So long term, I think it's one of the biggest positions that I have, personally speaking. I have to meet certain risk requirements on eToro. So I can't have a huge crypto exposure, right? Because it is pretty risky. But from a personal standpoint, outside of eToro, I do hold a significant amount of my own other investments in cryptos. And I firmly believe that crypto is just the future of money, just like letters became emails, dollars will become Bitcoins. It just makes total sense and is just a fantastic technology for the world. When we speak specifically about Ethereum, I think there's a lot going on in the NFT space, which is super interesting. The merge is coming soon. Again, these are going to be super volatile things, but if you're happy to hold it, if you know that you're not going to need the money for at least 3-4 years, I think it's one of the best investments that you can make right now. Solana reminds me a lot of Ethereum back in 2017. It's had this very steep correction, but again, for those of you who are in the NFT space, you might, or who actively use Solana and Ethereum, you'll realize that it has a lot of advantages in terms of costs and speed. So yeah, these are the positions that I have the most belief in, the ones that I hold on eToro, ApeCoin, Binance Coin, Bitcoin, Ethereum, and Solana. I do monitor a lot of other stuff as well, but I think not much else really comes close to these, to be honest. So I would consider adding more, but it would have to be once we've recovered a portion of the drawdown and we have more of a, I don't want to say guarantee, but if we look at Bitcoin, we're in a position where you could make the case that it's similar to October 18, kind of consolidating here on this support line. There's a chance that it just really falls dramatically to 15, 20, that kind of level to really shake a lot of people out. I tend to think it won't, but I don't want to add to those positions right now when there's still so much uncertainty. So on some kind of further bullish confirmation, let's say we get a breakout through here or we get a new high, then the drawdown would have reduced and it would seem like a safer bet. So yes, but I'm not in a rush to do so. Another question. Don't you think in the portfolio there are a lot of risk assets, crypto, especially ApeCoin, which for me is a meme token, and Solana? Also stocks like Palantir, Tesla, etc. Most of them not profitable and possible recession coming. If you're not sure where the market is heading, isn't it very risky to hold such assets? Well, there definitely are risk assets, but as I mentioned before, these positions have been opened through they've been carefully chosen. So if you look at, you mentioned Lemonade. So if you look at this in terms of relative strength, you can see that, okay, it's come way down since its IPO. But when the NASDAQ has been making several new lows, Lemonade has actually found support and has just been consolidating in a very tidy manner. And this is usually a sign that it could be a new leader. Basically, it has relative strength to the NASDAQ. So it is performing better in relative terms. So I think our stop loss on Lemonade will be, somewhere around here, or maybe if it makes new lows, and it's not a huge position. So I'm kind of just putting a toe in the water and I'm waiting. You can see here, this orange line represents an alert. So if we break through this pivot and reclaim the 50-day moving average, maybe we see strong volume or better earnings, if a few of these things start to add up, then this would be the position, the kind of stock that everyone is going to be ignoring because it's fallen so much, but actually it's a great business, and could really move. A lot of them are similar. Palantir and Tesla are not so great from a technical point of view, technical meaning chart, but hugely bullish on both of those for the longer term. Udemy is a little more like Lemonade. So you can see that it actually didn't make a new low, and then it was really recovering on some strong volume. So it's looking stronger than the indices, right? And that's always a good sign. And again, an interesting business. So yeah, we're just testing the waters with these stocks that could be potential new leaders. And then in terms of crypto, I realized that the Ape token is more of a risky play, but that's why it has a much smaller position. But that one is carefully chosen as well. you might have noticed that Yoni Asia, the CEO of eToro, has an ape as his Twitter profile as his Twitter profile. He has a bored ape, and he's someone who has been in the crypto space. He was very, very early, and he knows a lot about it. And I've seen a lot of people like him that have become very involved in the NFT space. And I think there's a lot of interesting things going on there. And Yuga Labs, who are the ones who own the whole ecosystem of the apes and the token, are really the leaders in the space at the moment. So I think having some exposure, I think it's 1% or something like that of the portfolio to something like this, is one of those asymmetric bets that I was mentioning, right? Where it may not work out. It is a very speculative position, but that's why it's small. At the same time, if NFTs become more mainstream, or this becomes some very valuable, or it already is very valuable, but if it becomes more mainstream or more successful in some way, it could produce an absolutely huge return. And we're sitting in a pretty comfortable position because I bought it as soon as eToro listed it, which was around $7, I believe. So it's had a bit of a wild ride, but we're not facing a huge drawdown. And yeah, I think it's good to have a mix of positions that are different risk levels. Yeah, you're welcome. You're welcome for the answer. I hope it makes sense. I don't see any more questions. I think we're probably running out of time. I'll let Hadas, do we have more time for maybe a last question if anybody has one?
Yeah, I think maybe we could give 1 or 2 last questions.
Okay, if anybody has any. If not, we can wrap up. And this is being recorded, so I'll post it on the feed, and you can take your time to look through it again and ask any follow-up questions if you think about them later too. Okay, doesn't look like there are any further questions. So thanks again, guys, for tuning in and for your questions. And again, I really appreciate you sticking around and trusting me through these very difficult market times, through these drawdowns. I really, really do appreciate it. And I will try my absolute best to deliver the best that I can for all of you.
Brilliant. Thanks so much, George. Fascinating as usual. And thank you all for joining. And yeah, George is definitely someone to trust. So
thanks, Anders.
It's great that you are trusting him. Great. So we'll see you all next quarter. Bye-bye.
See you soon. Bye, guys.